Chapter 18 Summary 1. A supply and demand analysis of the market for reserves yields the following results. When the Fed makes an open market purchase or lowers reserve requirements, the federal funds rate drops. When the Fed makes an open market sale or raises the reserve requirements, the federal funds rate rises. Changes in the discount rate and the interest rate paid on reserves may also affect the federal funds rate. 2. Conventional monetary policy tools include open market operations, discount policy, reserve requirements, and interest on reserves. Open market operations are the primary tool used by the Fed to implement monetary policy in normal times because they occur at initiative of the Fed, are flexible, are easily reversed, and can be implemented quickly. Discount policy has the advantage of enabling the Fed to perform its role of lender of last resort while raising interest rates on reserves to increase the federal funds rate, eliminates the need to conduct massive open market operations to reduce reserves when banks have accumulated large amounts of excess reserves. 3. Conventional monetary policy tools are no longer effective when the zero lower bound problem occurs, in which the central bank is unable to lower short-term interest rates because they have hit a floor of 0. In this situation, central banks use non-conventional monetary policy tools which involve liquidity provisions, asset purchases, and commitment to future policy actions. Liquidity provision and asset purchases lead to an expansion of the central bank balance sheet, which is referred to as quantitative easing. Expansion of the central bank balance sheet by itself is unlikely to have a large impact on the economy, but changing the composition of the balance sheet, which is accomplished by liquidity provisions and asset purchases and is referred to as credit easing, can have a large impact by improving the functioning of particular credit markets. 4. The monetary policy tools used by the European Central Bank are similar to those used by the Federal Reserve System and involve open market operations, lending to banks and reserve requirements. Main financing operations, open market operations, and repos that are typically reversed within 2 weeks are the primary tool used to set the overnight cash rate at the target financing rate. The European Central Bank also operates standing lending facilities which ensure that overnight cash rate remains within 100 basis points of the target financing rate.